Good afternoon, everybody, and welcome to our webinar this afternoon. This is a quick, short 30 minutes that you'll be spending this afternoon talking about real estate tax breaks, the ones that you may be overlooking. I'm joined with Tim Klimchock, who is a principal in our AEC division here at Stambaugh Ness, as well as Ryan Luckenbaugh, who's an advisor for the AEC industry as well. If you have any questions throughout this presentation, please drop them into the questions panel, as we do not monitor the chat box. We are not offering credits today because of the time of the webinar. And if you would like access to the handout that they will be going over in the next 30 minutes, you can go to the handout section of the GoToWebinar pane and download it from there. So without further ado, Tim.
Thank you, Kaylee. Appreciate everybody joining us today. Going through our agenda here, as Kaylee said, our goal today was to really talk about these at an introductory level, considering there are three pretty extensive topics over a 30-minute period here. We're going to start out with Ryan on the qualified opportunity zones and funds. We've heard a lot of discussion recently from the folks that we know in the industry that are talking about this. It's an exciting new area where there's some new opportunities. And then I'm going to cover some topics from some historical programs that have been in place for a while, historic tax credits and new market tax credits. It's definitely an exciting time in real estate development. We still see a lot of people busy and a lot of opportunities out there with continued historically low interest rates. However, there definitely is a need currently for finding other opportunities in interest rates rising and things getting a little bit tighter. So we hope that some of these strategies are worth taking a look at. So with that, I'll turn it over to Ryan to start talking about the qualified opportunity zones.
All right, thanks, Tim. So I'm going to try to say opportunity as many times as I can today. It just seems like it's a common thing with this. So one of the things I just want to mention is that some of the information that is prepared today is still based on some of the proposed regulations. There's still a lot of questions that are open, so just kind of keep that in mind as we go through here. First, let's get started here, just kind of going over a high level of what qualified opportunity zones are. Introduced by the Tax Reform Act back in December of 2017 through Code Section 1400Z. They're basically designated land areas that were selected by the governors of each state. The designations themselves right now are effective until December 31st of 2028, just as things stand now until they're further extended. There's approximately 9,000 tracts of land that are approved right now, and it includes both rural and urban areas, typically more in the urban areas. Next picture here that you see is a map that comes straight from the Department of Treasury's website. I have highlighted here just where we're at here in York, but you can go in. It's a really interactive map that you're able to drill down on any area within the country, identify where these opportunity zones are. So when you log into the Department of Treasury's website, it's on the Community Development Financial Institutions Fund page. Within there, it's pretty easy to navigate to. But it's kind of interesting to see where the zones are, and you can get a little bit more detail that way. So at the end of the day, we want to highlight kind of some of the major players and major things that happen with these qualified opportunity zone investments, starting off with the advantages and the incentives that as to why you would want to invest in one of these qualified opportunity zones. It's eligible for any taxpayer. Most any taxpayer that recognizes or realizes a capital gain during a year. It's an unlimited amount at this point in time. The gain itself is going to be referred to in many cases as the rollover gain. There are some related party limitations too to keep in mind with this whole process too. As far as this capital gain and then it's rolled over into one of these investments, it has to happen within 180 days of the realization. That 180-day period is a little different if it's an individual that's realizing the capital gain versus if it's a partnership or some sort of flow-through entity. The reason for that is if it's coming through a partnership, S-corp, something along those lines, it's either going to be or you're able to realize it at the date of that capital gain realization or at 12/31, whichever one's more favorable. Most cases, it's going to be that 12/31 because that gives you a little bit more time to roll it over. As far as the actual incentives to why you would want to invest in one of these qualified opportunity zone funds, which we'll get into in a little bit, is highlighted here at the bottom of the slide. Essentially, as soon as you would roll over into one of these opportunity zones, you have an immediate deferral of your capital gain and paying tax on that capital gain. We'll get through a little example here in a little bit. If you hold that fund then, or hold that investment in the qualified opportunity zone for 5 years, you get an automatic 10% step up in basis. That's an overall reduction of your capital gains tax. Once again, we'll show it through the little example here in a little bit. Hold it for 7 years, so 2 more years, it's a total of 15% step up in basis. And then 10 years, there's a full step up in basis to eliminate any capital gains tax on any subsequent gains. Back to that point, December 31st, 2026 is a very important date. The reason for that is at that point in time, your deferral ends and you pay any capital gains that you would have owed based on when you realized the gain originally at 2026. And I'll show you a little example, but the big thing is that if you want to realize that full 7-year holding period to experience the entire 15% step up, the investment has to happen in 2019. So here's our example here. Just a really simple fact pattern. Capital gain realized in 2019 of $1 million, rolled it into a qualified opportunity fund within 180 days. At that point in time, as I mentioned before, there's an initial deferral of $200,000 of capital gains tax. That's an assumption of 20% capital gains rate. I'm not factoring in any of the net investment income tax, any additional taxes that would be associated with that. So let's just say for initial deferral is $200,000 that you're deferring into the future. Let's say in 2024, then you still hold that investment in the qualified opportunity zone fund. There's an automatic step up of 10% or $100,000 in basis. So at that point in time, you've avoided $20,000 in tax. Hold it for another 2 years or a total of 7 years into 2026. You have a 15% total step up in basis, and total tax avoided is $30,000. At that point in time, keep in mind 12/31/2026. That's when you have to pay the capital gains tax, but you deferred it then in this case for 7 years. Another incentive that builds into this situation, let's say we hold it for a total of 10 years. That basis at that point in time is stepped up the entire way to fair market value. Any subsequent gain on the appreciation of that investment is not subject to tax. That's the big kicker there. So one of the things that I mentioned was the utilization of a qualified opportunity fund. The only way that you can get into these qualified opportunity zones for the investment benefits is if you use the investment vehicle called the Qualified Opportunity Fund. The Qualified Opportunity Fund, there's opportunity again, it can be formed as either a corporation or a partnership. And there's a separate process that they have to go through each year. It's called a self-certification process. It's filed on Form 8996. It's a certification process every 6 months. So this is one of the things that's very lenient with these types of investments, is that it's a self-certification. So it's simply a tax form that you include with the return each year. That basically it's your self-certification of the funds and where they're at within this opportunity fund. The big thing is this 90% test. So essentially, 90% of the assets of the qualified opportunity fund need to be invested in a qualified opportunity zone. One thing that's nice about the 90% test is that if it is failed during a year, during a 6-month period, it's not a revocation of the qualified opportunity fund. However, there are some penalties that get incurred that get reported when you file that 8996. Kind of continue on the qualified opportunity funds. Back on that 90% rule, there's different types of qualified opportunity fund assets that you can invest in. You got opportunity zone stock, opportunity zone business through the form of a partnership, and then the opportunity zone property. Within the opportunity zone property, there's different requirements. There's purchase requirements and substantial improvement requirements. There's a whole list of details that go into that. We're going to briefly touch on them in a little bit. But overall, the takeaway here is that going into a qualified opportunity fund, it's much more advantageous to go through either the stock or the business and create this two-tiered structure. Another thing to consider with these qualified opportunity funds is the fact that you can either set one up personally, or you can potentially just park your capital gains money into a qualified opportunity fund that has already been created. But we'll go through this next example, and it's going to highlight the advantages of going through the two-tiered structure versus the direct investment in the qualified opportunity zone property. So here's the two-tiered structure, just a basic picture. So basically, you have your investor at the top that realized the original capital gain. That capital gain was rolled over into the qualified opportunity fund. That qualified opportunity fund then invested in a qualified opportunity zone business. The investor itself kind of has the same impact, so there's no impact there depending on where they're going. That capital gain went into the qualified opportunity fund. The qualified opportunity fund then meets the 90% test by investing 90% of its assets into the qualified opportunity zone business. Okay, that business then has some less stringent requirements that need to be met each year. Here's a list of those. 50% of the activity in that business has to be active income. So there's kind of some things that we're waiting on as far as whether or not leasing and items like that classify. There's going to be some clarification on that we'll be able to get. Another thing is 70% of the tangible property within that qualified opportunity zone needs to be within the qualified opportunity zone. So that basically means, so you have 100% of your assets, at least 70% of those have to be within the zone itself. There's some other tests that get involved here. Another big thing at the end is there are a list of disallowed businesses as well. They're the commonly referred to as sin businesses. So the other structure then that I said is not as advantageous is the direct investment in the qualified opportunity zone property. So here it's kind of the same process. Investor rolls over the gain to the fund. The fund then meets the 90% test by putting 90% of its assets into the property itself. And then you have to meet these more strict requirements. There's a 30-month period that you have to substantially improve the property. And with that calculation, the land is not factored into that calculation, so it's more advantageous to apply more of that basis to the land at the point of purchase. Another thing with that too is that there's a purchase requirement. It has to occur after 12/31/17. So one of the common questions has been, can an existing property be classified as a qualified opportunity zone property? It can, however, when you go through this whole test of the substantial improvement and property, that does not get factored into that calculation. So it's more advantageous, going back to this other slide, and I'll show an example here of comparing the two, of going through the business first and then investing in the property. So let's just get into that right now. So on the left side here is the one-tiered structure, which I just explained. On the right side is the two-tiered structure. We'll go with the same fact pattern that there was a capital gain realized in 2019 of $1 million, rolled it into the qualified opportunity fund within 180 days. If you're setting up a one-tiered structure, $900,000 of that needs invested straight into the qualified opportunity zone property to meet the 90% test. That only leaves then $100,000 remaining to do the substantial improvements, whatever, as long as other stuff as funds get pumped into the fund then as well. As far as the two-tiered structure on the right side then, that same $900,000 needs invested into the business, qualified opportunity zone business, to meet the 90% test. But then if there's a property, only $630,000 needs invested into the property itself to meet the 70% test, which leaves $270,000 remaining at that point in time. So this is just a very high-level, simple example as far as why you would potentially, if you're going to go through and get the qualified opportunity zone property, to set it up in the two-tiered structure on the right compared to the one-tiered structure or the direct investment on the left. Just some other high-level notes just about these qualified opportunity zones and the investments is, let's say after 3 years, one of the qualified opportunity funds closes or is no longer existing. you can roll over your funds from that fund into another qualified opportunity fund, and it still keeps the same character from day one. So that's one thing that is advantageous with this. Another thing, depreciation recapture is not eligible for the deferral. There's some other things that we want to consider, one of them being that there's some uncertainty as to how the states, specific states are going to treat these investments. It's kind of up in the air right now. Most likely, they're not going to be in line with what the federal tax regulations are saying, the IRS is saying with this. So just another thing to be mindful of. Some other things that we want to consider too is just as far as like an overall investment, whether or not the investment is viable, that's obvious. But there's also some qualitative factors that go into this. There's a potential for it to be misaligned between the investment incentive of taking advantage of the tax deferral, the step up in basis, things like that, compared to the potential displacement of residents within those qualified opportunity zones. Just some things to think about. As far as like an economic impact, this is sometimes viewed more as a redistribution of economic activity rather than a generation of new economic activity. And another thing to keep in mind is this is another viable option in comparison to a 1031 exchange. So there's a lot to consider, a lot to try to squeeze into 15 minutes here. And without getting more in depth with it, I'm going to pass it off to Tim here.
Thank you, Ryan. Yeah, it's definitely an interesting area that there's, as you said, there's going to be more and more content that's still developed, and some of these questions that are kind of in a gray area right now, how those are going to actually pan out is still a little bit to be determined. So moving on to historic tax credits. Historic tax credits have been around for quite some time, but there have been some changes this year to make people aware of. First of all, an overview of the program. It is administered by the National Park Service and the IRS. The goal of the historic tax credits is really to incentivize rehabilitation and reuse of historic buildings. And the credits are available for commercial, agricultural, or residential rental properties. So getting into the basics of the tax credit, the amount of the credit available under the program equals 20% of the qualifying expenses of the rehabilitation. And I'm going to be covering that momentarily of what's a qualified expense. The tax credit is only available for properties to be used for business or other income-producing purpose. Again, this is really goes back to the same thing as the opportunity zones, where we're really talking about economic redevelopment and that a substantial amount of renovation is being done to the historic building. The building that receives the renovation needs to be certified as a historic structure by the National Park Service, and it has to meet certain requirements by the Secretary of the Interior standards for rehabilitation. So the process is 3 steps. Part 1 is identifying the building and making sure that it's deemed to be a historic building. The part 2 is the part that's a little more extensive, that really describes a description of the proposed rehabilitation that you're planning on in the building. And the real key area here is that the renovations that are proposed are not going to damage the historical integrity of the building. And then once you get to part 3, that's your certification, where the certification certifies that it's approved by the National Park Service and the character of the building has held its integrity and is available for the district in which it's located. Application fee-wise, once you get to that part 2 part from the previous slide, this gives you an idea of the fees that are involved for the submissions. It's really driven primarily based on the amount of the renovations that are being done to the property. So as I mentioned, the National Park Service and the IRS kind of do this together. So from the IRS's perspective, the building must be depreciable. The rehabilitation must be substantial. So they're looking, in order to allow the credit, that it's deemed to be a substantial rehabilitation to the property. Normally speaking, it has to be done within 24 months, but there is a way to establish a phase plan. If you have a project that's going to be done in phases and it's a little more extensive, that can be done over a 60-month period. The credit can only be taken when the building is placed into service, and at that point in time, they also require that, as I mentioned in the previous slide, similar to the National Park Service, that it is a certified historic structure after that time. So what expenses qualify? Basically, for the most part, any of your actual construction costs, including some of your soft costs like architectural and engineering fees, site survey, legal, and development fees. What doesn't qualify, as you might expect, include acquisition costs for acquiring the property, furnishing costs in terms of, furniture and decorations to the property, that sort of thing. Any new additions that expand the building, again, this is really driven by the redevelopment of the existing structure. And because it's focused on the structure, things like parking lots, sidewalks, and landscaping costs wouldn't qualify for the credit. Recapture, there is a couple of rules here. They're focused on the fact that you're just not doing this to get a tax credit, that you are engaged in the project that you're doing. So one of the requirements is you must own the building for 5 years. If in the event you do not own the building, there is a recapture of the credit at 20% per year. And it's worth noting that there is a possibility that if you do something after you get your Part 3 that damages the historical integrity of the building, they can remove the certification, which would require a recapture of the credit. Entity structure-wise, there's two different ways that we see this done. One is the direct method in which the partnership owns the property. The amount of the credit, the 20% of the renovation, that 20% needs to reduce the basis of the building's depreciable value. So the amount of the credit is going to be reduced by your basis is going to be reduced by the amount of the credit. Another way to do this is what they call the pass-through method, in which where there's two partnerships and one of the partnerships is designated in the operating agreement that they will receive the credit. In that case, there is no basis reduction, because it wouldn't be fair to the other partner who wasn't receiving the credit to have the basis reduction. Other tips and considerations with this: apply as soon as possible. I think it's important to make sure that in order to do the due diligence, make sure you're following the process, that you get started as soon as possible prior to when the renovation is done. It's recommended that you take pictures as proof that you're documenting what you're doing, and again, in terms of meeting the requirements of not damaging the historical structure, so they can see that. There's a lot of guidelines, and there's consultants out there that focus on this type of work, development companies that work with companies to do these submissions. It's recommended that you get some help from those folks. Anytime that you decide to make a change order to the project and it's going to be significant, it's best, again, to communicate those as a resubmission or amendment to your Part 2 when the renovations are going to change. And again, in our limited time here talking, wanted to mention that there are some restrictions that are there with regards to passive activity rules and at-risk limitations. So it's definitely something you want to talk to your tax accountant about before you pursue, just to make sure that you can take full advantage of the credit. 2018 changes. There used to be a 10% credit available for non-historic buildings that would follow kind of a similar format. Those were for buildings that were placed into service before 1936. That credit has now been eliminated. So in terms of historic tax credits, it's really only the 20% credit that comes into play. And the biggest change, which is disappointing for developers, is the fact that the 20% credit used to be realized in the year that the asset was placed into service. The change in the 2017 Tax Act said that now that credit is actually allocated evenly over 5 years versus the year placed in service. So you're still getting that benefit. It's just that you're going to receive that credit over a 5-year period from the date that the asset's placed into service. Moving on to new market tax credits. Again, our goal today was just to highlight this briefly because it's definitely a complicated topic and there's a lot of acronyms. But it really follows the tonality of the other two topics that we've talked about, which really is economic redevelopment. So the goal of the new market tax credit is really to incentivize business and real estate investment in low-income communities. This term CDE gets used a lot, which is the community development entity. So the credit is allowed for investors in equity investments in those CDEs. The CDE applies to the Community Development Financials Institution Fund each year for allocation authority. So once they get the CDFI, gives the ability of the CDEs to find projects to invest in. The CDEs work with developers and other folks in the area to identify qualified equity investments who can actually claim the credit. The developers can work in conjunction with these opportunities, and the developer working with the CDE and the investor, which is frequently a bank, to utilize the credit along with potentially offering other financing. So the key here is that many times from what we've seen, the actual entity getting the credit is frequently a bank, but there's favorable financing available to help make the deal work. The biggest thing that's imperative with this, so there's some rules with a Qualic B, Qualified Activity Low Income Community Business, and very similar to the opportunity credits, different percentages, but again, you'll see the tonality of it, that at least 50% of the total gross income is derived from the conduct of a business in the community. At least 40% of the services performed by the business employees are performed in the community, and at least 40% of the use of tangible property is used in the community. So again, the focus of this is that if this credit money is going to be available, that it's going to generate jobs, it's going to generate quality residential housing for families in that area. So the actual credit, the credit is awarded to the investors. It's actually a 39% credit of the investment paid, and it's paid out over 7 years. It's 5 years, 5% in each of the 3 years, and then 6% in each of the final 4 years. There is obviously a possibility, as I talked about with the historic tax credits, for the recapture of the credit. That comes into play when the CDE would cease to being a CDE and would no longer be allowed to issue the credits, or if the CDE redeems or cashes out of the investment. So they really need to be engaged in the project for the 7 years. So with that, that was a brief overview of the new market tax credits. We're happy to present today. As we mentioned, there's a lot of different moving pieces here, especially with the opportunity zones. And we'll be looking to potentially put some more content out there in terms of a longer webinar, probably specific to the opportunity zone sometime in the near future as well. So thank you everyone for attending, and I'll turn it back over to Kaylee.
Thanks, Tim. And if anybody has any other questions, there will be a spot in the survey to submit those questions. And there's also a question in there that Tim and Ryan would personally like to know. So if you could just take the time to answer a couple of those questions for us and give us some good feedback, we would really appreciate that. Without further ado, I will give you about 2-3 minutes of your time that you had for this webinar, and have a good day.